Good afternoon, everybody. So we are starting the session in the next 10, 50, next 2 to 3 minutes. Let the other student may join. Then we are starting the today's class. So we'll try to be cover the all the important topic for upcoming examination that is on Monday, and all the macroeconomics topic in next 45 to 60 minutes. We'll try to be complete within the time frame. So as of now, only very few students who have been joined. So we'll just starting in the next few minutes. Let the other student may join. Next 2 minutes, we are starting today's lecture that is all about the macroeconomics. So we'll start with what is macroeconomics, then what is national income, followed by what is the methods of measurement of the national income, then the unemployment, balance of payment, inflation rate, foreign exchange, monetary policy, fiscal policy, business cycle, money supply, unemployment. So we'll try to be cover all the important topic which is about to become on upcoming examination that is on Monday. I've already shared the PPT with the everybody. So if any one of you has not got the PPT, so you can send the math message. I'll be sending the PPTs to you. We'll wait for 2 minutes more, then probably by 2:07 we'll starting the today's class. That is all about the macroeconomics. I hope everybody is getting my voice. So without further delay, we are starting the today's class. Let the other student, already 30-35 students have been joined. And please do ask to everybody if in your informal group, so everybody can join and can take the advantage of the revision classes for the macroeconomics. So once again, good afternoon everyone. So we're starting with the very basics, what is all about the macroeconomics. So we have in the very first semester, we have been discussed about what is macroeconomics. Now, next topic is what is macroeconomics. So macroeconomics is all about whenever we talk about aggregate demand and aggregate supply, or it will talk about the overall economy overall as per the individual country, individual state. That's all the things come under the macroeconomics. It will talk about what is my demand, what is my supply. That comes under the microeconomics. But in the same time, we'll talk about the entire Alliance University, entire Bangalore, entire India demand of the any specific product and services comes under the macroeconomics. The macroeconomics covers the broader perspective of economics, and we do include all the aspect of the economy, whether in terms of the monetary policy or fiscal policies, whatever the issues are going on within the economy and across the globe, all the directly or indirectly affecting the macroeconomics. So what are the goals of macroeconomic policies? The first is all about the economic growth. So we'll try to be always ensure to long-term growth in a country output as measured by its GDP. As in the last week, we used to be the 11th largest economy in the world. Now we became the fourth largest economy in the world. So as per the specific government of country of respective state, so every time will anybody asking what is the macroeconomics goals, the very first thing which is striking in our mind, that is all about the economic growth. So we always try to be ensuring the long-term growth for the country output. Full employment, yes, we do know we can't create the full employment, but we just try to be create the near to the full employment. So achieving the low levels of unemployment, it's ensuring that all the who are the able and willingness to the work can find the employment. We are least bothered about those candidates who are not interested to do any work, that we do call voluntary unemployment. But all those people who are having the skills and they just want to be do the work, if opportunities are available for with those candidates, that is called. So we'll just try to be create the full employment. Price stability and inflation should be controlled. It should not be really hyperinflation, or it should not be deflation. So we just need to be control the inflation, maintaining the stable prices to preserve the purchasing power parity of the money with the help of the monetary policy and the fiscal policy. Then the balance of payment stability. All these topics we have, we'll try to be pick one by one topic, and we'll try to be cover all the balance of payment. What is all about the balance of payment? Here also I'm just telling you all the economic transactions from one country to the rest of the world within a certain period of time is called balance of payments. So there should not be deficit in a same time. We just need to be create the stable balance of payment. So what are the things in export and import, FDIs, FIIs, the loans, borrowings, all the things coming under the balance of payment. So we just need to be stabilize the BOP account. It should not be the deficit. Then equitable distribution of the income or equal distribution of the income. We just need to be, there should not be huge gap between poor and the rich. What we have, at least in India, we just need to be try to be minimize and remove the gap between the poor and rich through the progressive or monetary policy. So higher income people will pay the higher taxes, and lower income people will pay the lower taxes. So at least we can manage the equal distribution of the income. So what are the macroeconomics people do? Studying the economic trends. So we just need to be understand what happens before 10 years, and we are making out the planning for the next 10 years. So we just need to be understand the trends of economic. Then formulating the policies. In the same time, we have to make it out the policies. Formulation of the policy for the next few years. Last year, suppose that we have spent 100 crore rupees on a scheme like a Narega or a scheme like a Beti Bachao Beti Padhao. So again, with the past trends, with the whatever the resources you have, we have to be make it out the and formulate the policy for the future. Then forecasting the economic activities. Probably by the next 2 years, we are just before 4 or 5 years, the government of India has uh, told and expected they are going to be become the $5 trillion economy. So now we have in 2014 we have thought and we have made the plan. We will be in the next 10 years we are going to reach out to the top 5 economy in the world. Unfortunately, we have been now we have just in the last week we have been reached out to the top 5. Now we are in the fourth largest economy in the world. So we in the same time, with the help of the macroeconomics, what we are doing, we are forecasting the economic activities, then evaluating the effect of the policies, then whatever the policies we are making in terms of the monetary policy or fiscal policies, whatever the taxes we are keeping, then we have to be evaluate those things. When the GST came into the market in early few days, the GST was not GST policy was not in the favor of the corporate and the mid-level, the low-levels businessmen. But now, since last 2 3 years, what is happening? Every month, the GST data is coming in the box more than 2 lakh crores. In the same time, we have been discussed so many times about just like a UPI transactions also. When the UPI have been implemented, it was a very less transactions. Now, every month we are making out the more than 10 lakh crore transactions through the UPI. So we just need to be understand whatever the policies you have made, you have to be evaluate those policies. Then the global economic analysis. In the same time, we have to be understand what is happening in some other part of the country, and accordingly you have to be synchronize those policies. So what are the interest rate is going on? What is the exchange rate? Just before few years, we used to be have the against the dollar, we used to be at the 60 rupees. Now just in the last 2 months we have reached out to the 87, again became 84 due to the what is happening in a global scenario in terms of the trade wars. Earlier was happening with the US China trade war, then Ukraine Russia war, then Israel, Gaza and Palestine. What is happening since the last 3 4 days, at least in India, everybody can understand, due to the India Pakistan war, stock market has been almost declined by 250 point on just last Friday. So we have to be understand, and most of the people are expecting our exchange rate can be deficit up to the 87, 88 rupees against the dollar. Then advising the government and the organization. In the same time, macroeconomics also advising the government and the organizations. Then the next topic is all about, the core topic is all about the national income. So what is all about the national income? We just need to be all goods that are used as the input for further production process. So in a national income, we just more concerned about this. You just need to be understand, in a national income, we are more concerned about the final goods and services. So at least we can at least escape from the duplicacy. So if we are not making out the value of the final product and service, so it might have possibilities of the duplicacy. So what we do in the national income is just counting the value of the final product and services. It is classified as a final consumption. Goods are goods that flow to the ultimate consumers, and final capital goods are goods that finally used by the firms and production process. So, what are the factors affecting the national income? It's a political stability, as we can understand. If the government is very stable government for so long, 5 years, 10 years, so we can, which is directly or indirectly affecting the national income of the respective economies. Then the natural resources, whatever the natural resources we have, India is the super rich in terms of natural resources. There are many economies in the world which is having the superpower of in terms of natural resources. So natural resources in terms of the climatic condition, in terms of the land. So we just need to be bothered about the many factors while talking about the natural resources. Then how much lands we have, how much capital we have, labor and the entrepreneurs, technologies, what everybody have seen what happened just after the since last 7 8 years. Even the very small shopkeeper, even all the auto drivers, the taxi driver, they are using the UPI system. So, and how the technologies is evolving in the market, and how the technologies is affecting the national income. Then government policies, everybody's know the government policy directly, because government at the end of the day, government has to be managed and has to be set the policies and rules and regulations to run the economy. So these are the commonly known factors which is affecting the national income, starting from natural resources to the land, to the capital, labor, the technology, government policies, and the political stability of the economy. Then what is a core topic of national income? It is a measure of sum of all factors income earned by citizens of a country, whether within the country or abroad. Yes. If anyone is facing any doubt within the topic, then you can send the message and you can reply on the chat. I'll take your queries at the end of the topic. So national income, it is a measure of all the sum of the factors income earned by the citizens of a country, whether within the, if you're from India if you're from India, living in India or outside of the market, but it comes under the national income. So national income as a factor cost, so NNP at a market price minus indirect taxes plus subsidies. Okay, it's very simple. Then the GDP and the GNP. GDP measures the value of the final goods and services produced within a geographical boundaries, regardless of the nationalities of the individuals or firms. For instance, car manufactured in India, where Japanese companies will be included in a Indian GDP. So whatever the product and services we are manufacturing within the geographical boundaries of the respective countries in terms of the India. So within the geographical boundaries for India, whatever the product and services we are manufacturing by the foreign companies, but that will be considered under the GDP. Second is the GNP. GNP is measured by the value of the output produced by the nationals of the country, irrespective of geographical boundaries. If you are from India but you are operating your business in across the globe, so whatever the net factors income means export minus income, yeah, export minus import. What does this mean? If anyone from the outside of the India, they are doing certain business, suppose that any company that Google is earning the 100 rupees from the India, but in the same time Reliance is earning the 200 rupees from the US. So 200 minus 100, that is called 100 rupees. So we are going to be at the only 100 rupees with the GDP. So GDP plus net factor income from the abroad comes under the GNP. Then the NNP is very basic, just minus the depreciation. It is a GNP calculated after adjusting the value of depreciation. And NP is equal to GNP minus depreciation. So whenever we are just depreciating, making out the depreciation out of the GNP, that is called NNP. Then the NDP, net domestic product, the same thing. We just need to be minus the depreciation from the GDP. It is called net domestic product. This is you have to be understand GDP at a factor cost, GDP at a market price. So GDP fact, what is the meaning of the factor cost? Factor cost is all about, if suppose that you are the manufacturer of this particular pen, so whatever the cost incurred to produce the pen, that is called factor cost. So once you just need to find out the factor cost from the market price. The market price of 15 rupees. Factor cost will not be 15 rupees. It always is less than the 15 rupees. So what you have to do, because whenever you are reaching out to the market to buy this pen that costs 15 rupees, suppose that, so there is certain market price, there is certain taxes include, there is certain cost include. So what you have to do in a factor cost, we have, though therefore factor cost is equal to market price minus indirect taxes if there is any subsidies. So we have to be add the subsidies. So market price minus indirect taxes, that is called factor cost. But in the same time, whenever you have the factor cost is given, you have to find out the market prices. Then what you have to do, you have to be add on the indirect taxes minus the subsidies. If the factor cost is 5 rupees, cost of the producing of the pan is the 5 rupees, so you can't charge the 5 rupees the market price. So you have to include the taxes. So factor market price is all about factor cost plus indirect taxes minus subsidies. Then next topic is the same continuation of the national income, personal income, which include all the income including transfer payment which is received by all the individuals in a year. So national income plus transfer payment minus corporate retained earnings, income tax, social security. Very simple. Then we have discussed in the class also, we have discussed so many times, I have already made the PPT for whatever the topics we are discussing. PPT is already shared in the same time. For each and every topic what we are discussing, lecture is already in my YouTube channels. So real GDP is all about you just need to understand base year price and current year production is called. The base year is suppose 2010, then you have to be keep the base year prices of the product and the current year production, that is called real GDP. In terms of the nominal GDP, what we do, current year price is current year production. The current year price of 5 rupees and you are producing a 10 pen, it is become 50 rupees. But in a 2010, the cost of the pen used to be 3 rupees, your current production is 10 into 3, it became 30. The disposable income is all about personal income minus personal taxes. Clear? This is not an important topic. Even the green GDP, I am just telling you, it is an index of economic growth with the environmental consequences of that growth factors. So green GDP is equal to simple GDP minus the value of the environmental degradation, what we are getting on the year basis. We just need to be remove those things. We just need to minus those things from the GDP, that is called green GDP. Then the GDP deflator, in a very simple, GDP deflator is divided by nominal GDP divided by the real GDP is multiplied by the 100. Nominal GDP is 100 rupees, real GDP is 5 rupees, into the 100, you have to make it out the GDP deflator. The GDP deflator is measured used to access the inflation by reflecting the change in the price of all goods and services included in a country's GDP, offering a comprehensive picture of the economy price level. It is calculated as the ratio of the value of goods and services produced in a particular year at a current price. So in a simple, GDP is all about deflator formula allows economists to measure the extent of price change in the economy over a specified period. We just need to find out the in a base year prices were 10 rupees, now prices became 15 rupees. Your production is same, so you just need to understand how much percentage have been changed in the last 10 years, last 15 years. So GDP deflator helps to find out the real GDP actually. What this is all about the GDP deflator significance, reflection of the price changes. Earlier the price was 10 rupees, now prices became 15. So that is called 50% prices have been increased in the over period of the times. Comparison of the real economic activities. comprehensive measures of inflation, and accurate assessment of the real growth and long-term economic tracking. So these are the significance of the GDP deflator. So these are the very basic and the common scenario, common measurement of the national income method, expenditure method, and the value-added methods. In income, the first is all about formula for the national income using the income methods. So income methods, nobody in across the globe is using the income method. It's not what we call very popular, and you can't find out. Even you can understand, you can interpret it also. You can't pick it out any conclusive statement with the while counting your national income with the method of the income. Wages, rent, W plus R plus interest, what we are paying, what we are getting, profits of by the corporates, mixed income, net factors income from the abroad. So these are the component of the using the income method. So wages, whatever the wages you are paying, whatever the wages the people are getting, rent, W wages plus rent plus interest plus profit plus mixed income plus net factors income from the abroad. Net factor means export minus import. This is called income method. Expenditure is a very commonly known C plus I plus G, and again the net income export, net income X minus M. So GC stands for the consumption expenditure. It is a personal consumption made by the household, whatever the expenditure we are making on the market. So it is a personal consumption made by the household, payment to the which is paid by the household directly to the firms. Then the I stand for the investment in addition to the capital stock of the economy in a given time period. So whatever the investment has been done by the corporate, it again comes under the expenditure methods. The government expenditure, whatever the government expenditures are making in terms of the investing in terms of the infra, the defense, and whatever the expenditure they are making to build the hospitals, schools, and the roads, all these things will become under the government expenditures. Then the export minus import. Export, I think everybody's know what is the export, what is the import. So whatever the net will be there, then we just need to be add plus C plus I plus G, that is N plus net income. That is called expenditure method, and one of the most popular that is called gross value added, which is running because in a gross value added, whether it's the income method and the expenditure method, if anybody is asking is there any drawbacks and what are the benefits while using the gross value added and what are the disadvantages to using the income and expenditure method. In the income and expenditure method, we don't make the, and even when we used to be have these many method, we just need to find out the national income and the GDP of the respective economy. But the gross value added, we are making out the sector-wise GDP. What is the growth of the agriculture sector? What is the growth of the aviation sector? What is the growth of the tourism sector? What is the growth of infra? What is the growth of the banking? So gross value added is a measure of total output of the income in the economy. It gives the value of the amount of goods services produced in our economy after reducing the cost of all the inputs. The raw material used, the production of these goods and services. If suppose the raw total factor production cost is 10 rupees and we a market price at 15 rupees. So rather than calculating the GDP as for the 15 rupees, what we are doing, the input cost is the 10 rupees and output is the 15 rupees. So we are going to be calculating the 5 rupees as in a gross value added method. Because at that only 5 rupees you are going to be getting in terms of the profits. So GBA is the basic prices, GDP the factor cost plus production taxes, whatever the taxes we have, because at the end of the day, each and every people in terms of the manufacturer or the wholesaler, retailer or customer, every part of the supply chain management, they have to be pay certain part of the taxes. So GDP at a factor plus cost plus production taxes minus production subsidies under the GBA methods. This is one of the most popular methods. Understanding GB is a very simple way to explain GB is to saying is the context of the manufacturing process. During a manufacturing process, goods, energy, and service are dealt with. The associated costs are terms in intermediate consumption. At the end of the day, production process, the business has a product for sale for its own use. So in a gross value added, it just need to be understood that GB are more concerned about whatever the additional value we are putting in a product and services. We are more bothered about those things. So difficulties in a measurement of the national income, if anybody asks what are the difficulties, what are the challenges, government has to face to measurement of the national income. Non-monetization of the transactions, government countries like India still we have more than the 70%, 75% market is unorganized. Sometimes we are reaching out to the kiosk in the corner, they are not giving any bills to you. So in the same time, there is in a rural areas or still there is a water system. So there, whatever the non-monetizations of transactions, especially the water transactions in the rural areas, we can't include in a measurement of the national income. Unreported illegal incomes or black money, we don't include in the national income. Absence the data on the growing service sector, there are many service sector. All the laborers are working in India, the informal labor sectors in India, which is unorganized. So there is no data for that. How many people are working in your house? We are not providing the salaries. Not providing salary, we are providing the wages to those candidates in terms of the cash. So government of India don't have any record for those things. So absence of the data on the growing service sectors, just in the last 20 plus 2 decades, service sector has been grown up. Everybody knows that more than 60% contribution in Indian overall GDP or overall national income is coming from the service sectors. Work of the informal sector and the housewives we have already discussed. These are the things we are not discussing, and these are the things we are not discussing or not considering while calculating the national income of the respective economies. This is the very basic data of GDP. This is the data that earlier one. I've been found this data before in the month of February. So India is showing the fifth largest economy in the world. Just in the last week, India became the fourth largest economy in the world. So anyone is having it out in the meanwhile, you can ask. And the next topic is all about the inflation. Again, inflation is one of the most important topic for all the competitive examination who's preparing for whether for the UGC NET or UPSC for any bankings. Inflation plays a very vital role. When all those people who are about to give the MBA examination, MBA end-term examination, where also inflation always important topic. So what do you mean by the inflation? Inflation is very simple. Decrease in the purchasing power or general rise in the price value of the product and services. The sustained increase in the general price level, the product used, the pen used to the 10 rupees, it became the 12 rupees, so 20% is the inflation rate. Once there is a more inflation in the market, that means it directly related with the decrease in the purchasing power. Earlier it used to be the 100 rupees, so you could have been bought the 10 pen. The pen, one pen costs the 10 rupees. Now pen cost became 20 rupees, so you can buy only the 5 pens. So inflation always decreases the purchasing power of the money. These are the very important associated terms with reference to the inflation. The first is disinflation. Disinflation is opposed. It refers to the reduction in the rate of the inflation. Price level decrease without decrease in the national income, output, and employment. It is generally desirable. Suppose the price became 10. The normal price used to be 10 rupees. Very simple. It became 15. That is called inflation. But again 15 to the 13 rupees. That is called disinflation. Sometimes price level decrease without it decrease in the national income. That is called disinflation. So earlier the growth rate used to be the inflation rate used to be the 8%. Now inflation rate has become the 6%. Still there is inflation. This need to be understood. Just inflation rate has been decreased and reduced by just 2 to 3%. That is called disinflation. Then the deflation. Product used to be the 10 rupees now become the 8 rupees or 9 rupees. That is called deflation. Deflation is more harmful in the economy as compared to the inflation, as per my understanding, as per the normative economist and normative understanding of the economics. So it refers to the fall of the prices of the prices of products used to the 10 rupees became the 5. That is called deflation. Why this happens? You don't have money. Whenever there is no demand in the market, we have the 10 products, we have the 10 pen, only the 5 people are there to buy the pen. Then we have, at the end of the day, being in a marketer, I just need to reduce the prices of the pen. So demand is less as compared to supply. That is called it's a deflation. So less than the normal price, that is called deflation. Then the reflation. When the economy overcome the recession, the depression. What is the reflation? When the government of India, government of the respective state, deliberately increase the prices of the product and services. That is called reflation. So whenever we are overcoming from the recession and depression, while cutting down the monetary policy rate or in another way with the fiscal policy, what we can do, we can cut down the taxes. We cut down the direct taxes, or we can cut down, or we can sometimes, depending on situations, we can, earlier the taxes on the product used to be GST used to 20, now became the 25 or 15, depending upon the market what we have. So when the economies are overcoming from the recession depression in a situation with the price level increase along with the increase in the output, employment during the phase of the economic recovery. The inflationary gap is all about, it refers to a situation which aggregate demand is more than the productive capacities of an economy. That is called aggregate supply at a full employment level. So when we have the aggregate demand is more than the aggregate supply, so gap between the demand and supply, it is called inflationary gap. It might lead to the inflation also. The deflationary gap is just opposite of the inflationary gap. If the supply is more than the demand, so supply of the 10 marker, we have only the 8 people. who is going to be buying only the one pen each. So the gap between the supply and the demand, supply is at 10, demand is 8. Those two is just called deflationary gap. The recession, what we have discussed so many times in the class, is a situation which is characterized with a negative growth rate. Earlier, the GDP used the 5%. Your country was running with a pace of the 5%. It became the 4%. Negative growth rate, the two successive of two consecutive quarters, the two preceding years, that is called recession. Now, what happens in a recession? In a recession, there is a less demand in the market. So, it might, if there is less demand in the market for the so long, it might lead to the recession. Depression is a consecutive. Depression is a extreme form of the recession. There is no demand in the market. This happens once in a while in 19 or whenever we talk like a depression. So the very first tenure, very first era which is striking in our mind, that is called 1930 Great Depression in the market. So it's the extreme form of the recession that characterizes the situation where the recessions may have gone for too long, resulting in depression in the economy. Very simple. Then the inflation spiral. The inflationary situation in the economy will result of the process of wage and the price interaction. And the prices pull wages up. It's known as the inflation spiral. It is also in the wage price spiral. What is this meaning? Suppose that there is an inflation of the 10%. When your wages, then when your workers are reaching out to the company owner, sir, I'm not able to meet out the expenses. You have to be increase my wages. Then what the company owner does, they increase the wages 300 to 350 rupees. Now, when they've increased 300, 350 rupees, that means factor of the production cost increase. So just because the respective company want to be absorb the excess costs, what they do, again they increase the price of the product and services. Then again it became the inflation. This is a waste price spiral. I think you must have been got it. What it again? I'm just explaining you. You have been increased the prices of 10 to 12 rupees. Suppose that now, and your wages is same, that is called 300 rupees. Now your all those employees who are working in your respective organization, they are coming to you, sir, it has been 20% inflation has been increased in the last 1 year. You have to increase the wages prices. You have to increase the daily wages or monthly salary. So what what the businessman has done, he has increased the 20% salary. Now salary again became the 10 to the 12 rupees or 100 to the 120 rupees. So again their price, those people have demand is against constant. So again the price, again what will be happen? Then what the corporate will do, they want to be absorb the surplus expenditure what they are doing in terms of the wages. So they just need to be increase the price of the product and services. We'll discuss in a further slide cost push inflation, demand pull inflation. We all sometimes demand pull inflation. Why it happens? That's because there is more demand in the market as compared to supply. Cost push, if the factor of production cost increase, factor of production cost means labor cost increase, wages cost increase, rubber, it's in a plastic cost increase, electricity cost increase. So at the end of the day, you have to increase the prices of the product and services. So that is called wages price spiral. Then overheating of an economy, it is a situation during the boom with further increase in aggregate demand fails to the increase the real output. Maximum you can in a one point of a time you can't increase more demand in the market because there is a space there are certain product and services you can't increase that demand up to some extent you can increase. After that, if you want to increase more demand, it is the concept of overheating of the economy. It might resulting in the inflation in the market. Then suppress and repress inflation. It refers to the situation where the AD is aggregate demand is greater than aggregate supply, but government prevent price level from rising through the direct price control measures like price regulation, ceiling prices. Suppress and the repress inflation. Sometimes aggregate demand is more than aggregate supply, but government have the control of the certain product and services like a crude oil or petroleum product or telecommunication, where there is all the product bases, all those product bases coming under the oligopoly market, where the government is having the intervention. Government fix the prices; they are keeping the price ceiling. Then the open inflation is all about a situation with the price level increase without any price suppressive measures by the government. Sometimes due to the market forces, your prices of the product and service increase. That is called open inflation. Then the Measuring index is all about it is a summation of the inflation rate and the unemployment. These are the very important topic in Measuring index Phillips curve. It is a summation of the whenever we are adding the inflation rate with unemployment, that is called Measuring index. Then the stagflation is a situation with the high inflation is accompanied by the recession or the unemployment. You have the high inflation in the economy in the same time it is accompanied with the unemployment and the recession. It is also called inflation with the recession and the unemployment. It is caused due to the cost push inflation. Then the core inflation is all about, it is based on the price of only those commodities whose prices are non-volatile. It does not take into the account price of the food and fuel. The core inflation, in the core inflation, we don't include the prices of the food and the fuel. That is called, and because the food and the fuel is always volatile, and remaining the product and services, this is not a volatile as just like a food and fuel. So in a core inflation, we are more concerned about those commodities where the prices are not volatile. Then the headline inflation, it is based on the price of the all groups and types of commodities. This is the very basic concept: aggregation, agri-inflation, food inflation, and inflation and this lab. Then we have discussed, I think there is no topic like a Phillips curve here, but Phillips curve is all about one of the most important topics in every examinations. It is the inverse relationship between the unemployment and the inflation rate. Clear? It is a inverse relationship between the unemployment and inflation rate. That is called Phillips curve. So this is all about the types of inflation. Again, depending upon the economy to crop creeping inflation 1 to 5%, trotting is a 5 to 10%, hyper is more than the 50 or more than the 100. Then we have two types of inflation. There are cost push inflation and the demand pull inflation. What there are many causes of demand pull inflation. We are discussing about these many demand pull is all about when the demand is more than the supply. So when the consumers spending increase, government spending boost, lower the interest rate, rising the export. Rising export means if we are having the, suppose you used to be produce the 100 pens and used to be the demand of the only 100 pens in the market in India. But what happens? You started exporting the 50 product to the overseas market just because of more profitability. Now we have a demand, we have a supply of only 50 product, but demand is 100. So sometimes rising the export or lower the interest rate, government spending or increase the consumer spending, that is called demand pull inflation. What is the impact? Higher prices due to the increased demand and commonly is rapidly growing economies. In economies like India, sometimes it happens the demand inflation for the seasonal product during the Holi, Diwali, the Bakri, or any festival season. What happened? Demand is more than the supply, so that is called demand inflation. Next, the cost push inflation. Cost push inflation, if suppose I've already discussed, if wages price increase, salaries increase, technology cost increase, factor production cost increase, so that is called cost push inflation. So arises from an increase in the cost of production due to rises wages, increase the price of low raw materials, higher taxes on the goods and services, supply chain disruptions. Due to the any war between India, Pakistan, Ukraine, Russia war, or due to the COVID-19, what we have been seeing, there was supply chain disturbance. Whenever there is supply chain disturbance, so there will be automatically the cost for the product and services will be increase. What is the impact? Higher production costs passes to the consumers. The production cost of pen will be increased. So at the end of the day, who is going to bear those costs? Customer or consumer has to be paid. Then the built-in inflation, same. Somebody was discussing about the built-in inflation. Workers demand the higher wages to keep the cost of the living. The same what we were discussing in the previous slide. Businesses increase the prices to cover the higher prices cost. Wage price spiral, the same thing. The built-in inflation. When you ask the more wages, so what the marketers does? Marketers has to be absorb those costs. They increase the price of the product and services. That is called built-in inflation. This is called impact of the inflation. I think everybody is know interest rate, impact of interest rate, erosion of purchasing power. Your purchasing power always decrease, saving and investment. This is the social impact of the inflation. Standard of living sometimes increase or decrease, wage price spiral, poverty and then inequality. So this is all about the headline, the core inflation. What is the core inflation? We have discussed in the core inflation, we don't include the food and the fuel. We are more concerned about the only non-volatile items. The core CPI exclude the food and energy prices from the CPI. So this is, you can refer, this is a very simple. So measurement of inflation, WPI and the CPI. In a WPI based on the wholesale price of selected goods, not services. In a WPI, more concerned about the only product and services of a selected market. It constitutes three major groups: primary articles, fuel in power, and manufactured goods. The estimated by the whom estimate the Office of Economic Advisor under the Ministry of Commerce and Industry. Base year is the 11 and 12. What are the significance of WPA? Indirect taxes are not included while estimating the WPA and does not account for the product of the unorganized sectors in India, because in unorganized sectors we don't have data. The consumer price index CPI is inflation is calculated at the consumer's level. Retail inflation, what we are talking, At a wide disparities in the consumption basket for the different segment of the consumer, we have the four different CPIs. The consumer is a retail prices we are talking about. The wholesale is a wholesale market. So in a CPI, we have a CPI industrial workers, CPI urban, CPI agricultural labor, CPI rural workers. So CPI industrial workers mainly used for determining the DRS allowances. Everybody is known as state government or central government. They are getting the DRS allowances because sometimes government of respective state or respective country, what they are doing, they are announcing the DNS allowances twice in a year, so at least they can meet out with the inflation rate, whatever the prevailing inflation rate is going on. The CPI urban non-manual implies this index deficit the change in the price levels of average retail price of goods and services consumed by the urban segment. Again, it is used for determining the DNS allowances implies of some foreign companies, all those people who are working in some foreign companies. So where we are using the CPI non-manual implies the base year for CPI 2016 for CPI non-urban, that is for 1984, 1985. CPI agriculture labors, everybody know all those people who are in agriculture, where we are calculating the CPI agriculture labors. Ministry of compiled by the labor bureaus, Ministry of the Labor and Employment, and base year 86 and 87. See, where rural workers, all those people who are working in Naregas or rural government schemes, where we are counting or making out the accountability of the CPI. So inflation measurement based on that there are two periods, annual average inflation rate, average of inflation rate in the last 52 weeks, and point to point inflation rate. Point to point inflation rate is supposed that today we are in the May, on 9th of May, suppose, or 9th or 10th of May, we are in the second, we are the our financial year started from the April 1st, so probably we are in the 6th week of financial year 25-26. So point to point inflation rate, we just need to be understand. So today the price of the market pen is just 10 rupees. So we just need to be understand what was the price in the last year in the 6th week, the same period. Sometimes we are making out the annual average inflation rate, sometimes point to point inflation rate. Then the next topic is all about the unemployment. So unemployment is, I think everybody know, in a situation where the individuals are ready and willing to work at the prevailing rate of wages but can't get it the work. According to the NSSO, unemployment is a situation which all those work owing to the lack of work or not working but either seek work through the employment exchange, intermediaries, friends or relative. In a very simple definition, if you have the skills, you have the qualification, you are having the willingness to work also and not getting the job as per your profile, as per your capacity, as per your skills. That is called unemployment. So number of unemployed, labor forces minus workforce sphere. So if suppose that 100 people are ready to work and they have the skills also and 80 jobs are available in the market, the 20% people are unemployed. Simple. So types of unemployment, cyclical unemployment due to the lack of a demand in the market for their whatever the work and whatever the work they are doing. So if there is no demand for those works, so that is called cyclical unemployment. Frictional, a person leaves or loses a job and starts looking for another. That is called frictional. Suppose today you have been resigned from the organization A on the 10th of May and you are joining the next organization on 10th of June. So these 30 days will be called as a frictional unemployment. So the gap between joining from the one organization to other organization, so you'll be getting employed for the few days. Sometimes you got terminated, you have somebody had let out. So sometimes you have to wait for the 6 month, 1 year to search out the new job. That is called frictional unemployment. Third is the seasonal unemployment. This occurs during a certain duration of the years. For example, seasonal tourism at a hill station. So there are many people who are working in the tourism sectors during the just like in terms of North Indian or South Indian part of the country. So what is happening? What are the issues that are going on in the India and Pakistan? So all those people used to get the employment during the summer season in Kashmir, but due to this India Pakistan war, so or sometimes due to the seasonal changes in a winter or summers in Goa, people are crazy about to go out to the during the New Year's. So this is called seasonal employment. So you work for the certain specific point of the time, then you get it unemployed. The structural employment due to the structural change in the industry that leads to the mismatch between the skills offered and skills needed. So sometimes government of India, government of respective state, what they are doing, they are making out any structural change in the economy. Just before 2 decades back, when the government of India has change the scenario of the traditional banking system to the computerized banking system, CBS. So government of India and the RBI have been forced and asked to everybody to you have to be learn the basic computer, then only you can survive in the banking sector. So whenever government of India, government of respective state making out any structural changes like a GST, demonetizations, technologies, or any new skills. So there are many people got the unemployment during that time, during the demonetization also, during the GST also. Underemployment, situation where the person with the high skills works in low wages. You sometimes we are getting the news, getting the post on the Instagram, LinkedIn, Facebook for the PN for the fourth grade government job, ITs and PhDs and masters and MBA and BTech people are applying for those jobs. So you are meant to be for the somehow mid-level manager's job after your MBA, but you are getting the core sales or undergrad or you are working BC call center BPO industry. Even anybody 10+2 guy can do perform the job. So sometimes underemployment, you are having the high skills, but you are working now, not working as per the full capacities. The disguise and employment, when a person is somebody have given the, I don't want to stick the say the example of the same somebody have given the example of some certain department within the university. So disguise and employment, when a person is employed in a job where the presence or absence does not make any difference to the output of the economy, that is called disguise. Suppose that I am taking any classes, as of now I'm taking any classes. If any other faculty is sitting to me and you are able to watch, you're able to see over on the camera, over on the what camera I've been indicated while taking the online classes. So is the sitting with me, the faculty is sitting with you, but there is no role of those faculty while to disseminate the information to teach any concept of macroeconomics or concept of any topic what we are discussing. So sometimes when a person is employed in a job but their presence or absence does not make any difference to the output of the economy, that is called disguised. Then open unemployment, a situation where workers are willing to work at a prevailing wage rate but they are forced to remain unemployed in the absence of. Sometimes you are ready to work with a certain 200 rupees and 250 rupees or 300 rupees, whatever the prevailing rate is going on, but work is not there. Natural unemployment, I always say, as per the normative economics, unemployment is a part of the economy. Unemployment ranging of 2 to 3% in the country is considered natural or inevitable. It will be there. You can't even, this is the minimum one. You can't minimize less than 2%, less than 3%. Then full employment, it is not a perfect, but near to the 96%, 97%, 98% we do call the full employment. This is all about the types of unemployment. You have to be understand. There are so many, I think everybody knows in India types of what are the reasons of unemployment, effective education system. We do discuss so many times. I do discuss at least so many times the classes. People who have done the MBA, they don't have basic understanding of the communication skills or basic aptitude skills. Basic being in an MBA second semester, third semester, fourth semester, they don't have basic understanding about the specialization they've been opted in a second semester. So sometimes defective education system, at least in India, it is a perfect example of reasons for unemployment. Slow economic growth, if there is not economic growth, if you are having very good skill, but economic growth is not as per the standard, as per the market rate, then again it is a reason for unemployment. Lack of the infra development, if you don't have infra in the economy, India is behind its competitors when it comes to the infra, such as roads and logistics. The cost of time involved in getting goods from factory to destination are greater than those for other countries. So lack of infra, poor ranking in the global competitiveness indexes, rapid population growth. If the population is more in India, again population is a very big challenge. Inadequate employment planning for the government in comparison to the population growth. Sometimes we don't have plannings to make it out the adequate employment. Then lack of the entrepreneurship culture. Nobody want to become an entrepreneur. Everybody want to be work. At least universities, B grade universities, C grade university, even the A grade universities, they are more concerned about the getting the package of 50 lakh rupees, 1 crore rupees. But they, at least in India, no university across the globe is publishing the data. These many people have been started the startup in a very first semester. Now they got the unicorn or they have been reached out to a certain state. Everybody is publishing the data of these many people have been placed at these many companies. So still in India, it's a very big challenge, a very big problems like of entrepreneurship culture in our education system. What are the consequences? I think everybody knows the unrest in the population, low economic growth. There are so many there are so many reasons of unemployment, unrest in the population. What is happening in Pakistan? What is happening in Bangladesh and Sri Lanka? What happened in Venezuela? What happened in Zimbabwe? What happened in Turkey? There are so many economies in the world we can take the example of. what unrest in the population, low economic growth, vicious cycle of the poverty, lower social indicators in the burden of the government. This is a very basic source of exploitation. Loss of labor efficiencies, adverse effect on the savings leads to the inequalities of the income. This is the Phillips curve what we were discussing about relationship between the unemployment and the inflation rate. There used to be the one Professor Phillips. He has focus and emphasis on there exists a close relationship between a level of unemployment and the rate of wages increase in the economy. The relationship between two it deficit in the forms of Phillips curve. What we do when the more the inflation rate, okay, and in the same time less unemployment. The graphical which advocate relationship between inflation and unemployment in our economy. As per the curve, there is a trade-off between inflation and employment. An inverse relationship between them. The curve suggests lower the inflation rate, higher employment, higher the inflation rate, lower than employment. But up to the some point of the time. The next topic is related to the inflation that is called business cycle. Business cycle refers to the period of the high growth and prosperity in the economy. Just like in terms of the marketing, we do teach the product life cycle. In terms of the economy, we do teach the business cycle. In terms of the trade, we do discuss the trade cycle. In terms of the life, we do discuss start from the infant to the kids to the adult to the maturity level in the old age. So in each and every part of the product and services, whether it's part of the economy, we have certain cycles. So business cycle refers to the period of the high growth and prosperity in the economy, followed by the period of the sharp economic slowdown, the depression. So during the phase of the prosperity, what we have to do, you just need to be understand under the business cycle, under the recession, what strategy, what decision you have to be take, what in terms of the prosperity, what decision you have to do, and during the slowdown, what are the policies you have to make it out. During the phase of the prosperity, the economy experience high growth rate in the national income. Rates are above the potential growth rate. The economy also experience a high growth rate in terms of per capita income. So when the things are going good, so every macroeconomic indicators will be increased in terms of per capita incomes to the investment to the employment. The phase is also characterized by the reasonable high inflation rate. During the period of the slowdown, if there is a economic is facing slowdown or recession, the economic experience a decline in the growth rate in terms of national income also, in terms of per capita, to the investment, to the unemployment, to the employment also. So we have the four basic phases of business cycle. Business cycles of booms and slumps. The economic activities reflect the upward and downward movement in economic variables. Typically, business cycle has four distinct phases, starting with the expansion, also called a boom or the upswing, the peak of the boom and the prosperity, then contraction, and throughout the depression. So starting from the trough to the expansion, then the peak, then contraction, then trough. So in every 10 years, you will see the data of the last almost 100 years. In the 1930, we had a recession. We have been recovered till 1944, 45. Then we had in the 1962. In the third five-year plan, our GDP was approx 2.8. We used before the Niti Aayog, we used to have the 5-year plan. The very first 5-year plan we have made 51 to the 56, then 56 to the 61, then 61 to 66. The third 5-year plan we have made the GDP prediction of GDP of 5.6, but we have achieved 2.8. So in the 1962 we had a recession, then 1971 we had a recession, in 1983, 84 during the Gulf War we have discussed the movie of the year lived also. Then the 1991 we have done the economic reform. The 1997, 1998 we have a Asian financial crisis, AFS. And in a same time we'll see that during the 2007-8 during the US bank Lehman Brothers bank crisis we had a recession. In 2018 and 19 it was about to be again the recession, but what happened suddenly due to the natural factor that is of COVID-19, again we have been not be across the globe was in a recession except the very few economies. So it is a cycle. It started to throw to the expansion to the peak to the contraction, but you just need to be understand what decisions, what policies, what are the policies you have to make. The expansion phase is characterized by increase in the national output, employment, aggregate demand, capital and the consumer expenditure, sales, profit, rising stock price, and the banking credit. You just need to be understand in terms of the expansion, all the macroeconomic indicators will be increased, but in terms of you'll see the recession, depression, all the macroeconomic indicators will be decreased. So as of now, we are discussing about the expansion. This state continues till there is a full employment of the resources. Production is maximum possible level using the available production resources. Price and cost also tend to rise faster during the expansion time. Goods amount of the net investment occur, and demand for all types of goods and services always rise, there is altogether increased prosperity in the economy. In the peaks, sometimes even the product life cycle also see in a late maturity, but everybody know up to the late maturity we are going to the decline. If you're reaching out to the already reach out to the peak, then you just need to understand the later stage the expensive inputs are difficult to find that they are sort of their demand, and therefore input prices increase. Once the input prices of the product and services will be increased, the output prices also that is called cost plus inflation. So when the input prices of any product and services increase, then output prices has to be increased rapidly, leading to the increased cost of living and greater strain on the fixed income earners. The consumers begin to review their consumption expenditures on the housing. Then what you have to do, your purchasing power will be decreased, and when the purchasing power will be decreased, your demand will be decreased. Low demand, then low production might lead to the recession also. The consumers begin to review the consumption expenditure, the housing, durable goods. The actual demand stagnate, and this is the end of the expansion. It occurs when the economic growth has reached a point where it will stabilize for a short time, then move in the reverse direction. Then contraction, as already mentioned here, the once a peak is reached, increase in the demand is halted. Now it start decreasing in the certain sectors. During the contraction, there is a fall in the levels of investment in the employment. So producers don't instantly recognize the pulse of the economy, continue anticipating the higher level of the demand, because everybody's overnight you can't predict what are the demands you have. So what we were experiencing the demand since last almost 10 years. So you are continuing with the same production cycle, or you are continuously with the same products number of the product you are producing. So what we do, so sometimes you are producing the 1,000 products in a day, but your demand became 800. So you are producing 1,000 in a day. In a year, year monthly you are producing 30,000. So the demand has been decreased by 20% by day. So in monthly it became almost per day your demand decreased by 20. That is for 200. So 200 multiplied by 30 it becomes 6,000. So you have your aggregate supply was a 30,000 product, but demand is only 24,000. So what happened? The 6,000 product will be in a surplus. At the end of the day, you have to be sell those products at a very lesser rate. So it might lead to the deflation, it might lead to the depression also, it might lead to the recession also. Supply far exceeds the demand. Initially that happens only a few sectors at a very slow pace, but rapidly spread all across all the sectors some point of the time. And throw in the depression is a severe form of the recession characterized with extremely sluggish economic activities. This happens once in a we have been given the example in the PPT also. For example, the Great Depression of the 1929-1930s is still cited for the enormous miseries and human suffering is caused. So in the last 100 years, we'll talk about the Great Depression. So we have only the one understanding, one Great Depression understanding, that is called 1930. There were several reasons behind that. World War One, World War Two, stock market crash, and the U.S. presidential election. It started with the one major factor, but again, what happened is became the spiral of the many macroeconomic indicators. It might lead to the Great Depression in the economy back in 1930. Then again, every no after the depression will try to recover from the economy. The economy can't continue the contrast endlessly, so it reaches the lower level of the economic activity called trough, and then start recovering. In a COVID-19, in a very first quarter of the 20, what happened? Our GDP was minus 27%. Then it gradually start increasing, then 3%, 4%. Now we are running with a decent 5%, 5.5, 6%. Even now, I is predicting 6.2, sometimes 6.6 also. This is all about the examples of business cycles. Great Depression of the 1930s, information technologies bubble burst in 2000, global economic crisis 2008 at the nine. Most recent example I've already discussed about this. So this is all about the business cycle. What are the leading indicator, what is lagging indicator? We have discussed these many things already. So what are the causes? Internal causes: fluctuations in effective demand, fluctuations in investment, variations in government spending, macroeconomic policies, whatever the money supply reduce, increase or decrease, psychological factors also. Then we have certain sometimes external causes: wars, what is happening in India and Pakistan, Ukraine, Russia and Israel and Palestine, wars and post-war reconstruction, technology shocks, natural factors, population growth. So these are the causes of the business cycles. So in related with this, we have the next topic is all about the money supply. So what is all about the money supply? Government of India just want to be understand how much money they have been. At the end of the day, RBI is printing the currency, but at the end of the day, government of India is also keeping the record of all the money. So whatever the money is in a flow, so government of India has just need to be keep the record of those things. What are the money they have been? If suppose they have been printed 1,000 crore rupees, and how much money out of those 1,000 crore rupees in the market, and how much money they have been in the form of cash, in the form of fixed deposit, in the form of recurring deposit, in the form of investment, in the form of the stock market. So there are many things. So money supply measures refers to tools used to measure the supply of money in the economy. In India, the RBI has been using the following tools as the money supply since last. So we have been categorized the money supply in M0 to the M1, M2, M3, M4. The M1 is called narrow money and M4 is called broad money. So M0 is the reserve money, M0 is the currency in the circulation, whatever the money is the currency in the circulation. Why the government of India has done the demonetization in a back to 2016, this was again one of the reason. They have been, till that time, they have been printed almost 16 lakh crore rupees currency, but out of those almost 30-35% currency was not in the circulation. Some people have been blocked those currency. They have been kept as the black money. So what are the M0 is the reserve money, M0 is the sum of the currency in circulation. Bankers deposit with the RBI and the other deposit with the RBI. It's very simple. Come to the M1. M1 is the narrow money. Narrow money is the currency with the public's net demand deposit held by the commercial bank. Net demand deposits. The M2 is equal to M1 plus saving deposit with the post office. Whatever the money we are saving, depositing in the post office, when we are adding with the M1, that is called M2. M3 is called the broad money. M3 is M1 plus net time deposit with the banking system. Net time deposit means whatever the money we have been deposited with the banking with the form of the recurring deposits and the fixed deposit. So whatever the money we are keeping with the in the form of the FDs and the RDs, that is called net time deposit with the banking system. So M3 is the M1 plus net time deposit with the banking, that is called M3 is the broad money. M4 is the sum of M3 and the total deposit with the post office's saving organization excluding the NSC. So we can buy the NSC also from the post office, National Savings Certificate, but we don't include in M4. So M4 is all about the M3 plus total deposits, whatever the money we have been put deposits with the post office. Now we have in the post office, we have the bank account also. So whatever the money we are keeping with the post office, in adding with the M3, that is called M4. Very simple. So, see, almost 60 minutes. We'll just bind up the lecture in next 30-35 minutes. We have the important topics. It's monetary policy. In each and every country, we are making over two different policy: monetary policy and the fiscal policy. Monetary policy managed by the central bank of the respective state, respective country. Fiscal policy always managed by the central bank of the respective state or respective country, that is called Government of India. So what is the monetary policy? Monetary policy is managed by Central Bank of the India. These are the objective of the monetary policy: full employment, price stability, accelerating the economic growth of the country, balance of payment, and exchange rate stability. We have discussed so many times. We have the dedicated lectures for the monetary policy in my YouTube channel. You can refer those things. You just need to understand what are the tools and techniques of the monetary policy, which is one of the most important. In most of the competitive examination, most of the academic examination also, they do ask how can we measure, how can we control the inflation and deflation with the help of the monetary policies tools. So this is all about the objective of the monetary policy. We will not be discuss these objective in details. And coming on to the, we have two types of monetary policies: expansionary monetary policy and contextual monetary policy. Expansionary monetary policy where we have to be applying, contextual monetary policy where we have to be apply. So in expansionary monetary policy we apply, we just want to be expend the money supply. That is called cheap money. If the economy is, you just need to be understand where we are applying these many monetary policy. If we are running a deflation, running a recession, we are following the expansionary monetary policy. How you can increase, how can you apply the expansionary monetary policy? With the help of the money supply. So increase the money supply by making such credit supply easily available. Money produced through such policy is called the cheap money. Expansionary or easy monetary policy aims at encouraging the spending on the goods and services by expanding the supply of the credit. If there is a deflation, if there is a recession, what you have to do? You have to be follow the expansionary monetary policy. How will you do? I'll just try to be tell you through the tools of monetary policy. You just need to be cut down the rates. When EMP is required, lower level of the growth, high level of the unemployment, deflation slow down. Contextual monetary policy is the opposite of the EMP. when you have the high inflation rate in the market, then we just need to be cut down the rate. We just need to be minimize the. We just need to be control the inflation with the help of the monetary policy while increasing the interest rate. Simple. What are the instruments of the monetary policy? These are the quantitative measurements: CRR, SLR, bank rate, repo rate, reverse repo rate, MSF, and open market operations. Starting, this is the policy rates by the 2 days. So now you have examination on the day by tomorrow, or if anyone is off, you is giving the examination after 1 month, 2 months, or 3 months, then you have to be understand. You have to be check the you have to be do regular check the rates of these many policy rates on the from the RBI website. So this is the rate as because in the last monetary policy MP monetary policy committee meeting we have been cut down the rates. So as of now, policy repo rate is 6%, reverse repo rate is 3.35%, marginal lending facility we do call MSF is 6.25, bank rate is 6.2. In terms of reserve ratio, we have the CRR and SLR since so long, 4% and the 18%. Now, what is cash reserve ratio? Cash reserve ratio is share of the bank's total deposit that is mandated by the RBI to be maintained with a later as a reserve in the form of liquid. In the simple language, just need to be understood. Each and every bank has to be keep certain amount of the money in the form of the cash with the RBI. So what is the percentage? That is called 4%. If suppose that you are earning your bank is having the 100 rupees, and of the I'll be discussing that is called NDTL. NDTL is all about net demand and the time liabilities. What is the net demand and time liabilities means? We are maintaining the NDTL in every 15 days. Each and every commercial bank has to be understand what are the net demand and time liabilities they have. Suppose that bank is having 100 rupees and banks is having the demand and time liability of 20 rupees. That became 100 minus 20, it became 80 rupees. So out of those 80 rupees, bank has to be keep the 4%. Out of the 80 rupees, 4% became 3.2 rupees. The commercial bank has to be keep 3.2%, 3.2 rupees with the RBI in the form of cash. So the bank can't use those amount for lending and the investment purpose and does not give any interest. So RBI is not giving any interest rate on those things. The bank can't use those money for any investment or any giving the loans. So you just need to be understand the concept of the NDTL, demand and the time liabilities. Demand and time liabilities means we commercial banks are maintaining the NDTL in every 15 days. You just because NDTL for banking refers to aggregate saving account, current account, and the fixed deposit. If anybody have invested the 100 rupees in the bank deposits just before last 1 year, their maturity not by 11th of May. So if your maturity on the 11th of May, so any that customer can come anytime. You just need to be keep in mind of those amount. So you have to deduct those all those funds which in the form of the NDTL. Then whatever the money which has been left with you, then and you have to be keep the 4% of those money. SLR is statutory liquidity ratio is again the same, but that's slightly different. SLR is all about which is running 18% in the market. SLR you have to be keep the 18% after once you will be deduct the NDTL and once you will be deduct the CRR. After the CRR, whatever the money which is being left, and you have to be keep the 18% of those money in with the form of the state liquidity. Clear? So Reserve Bank of India has mandated every bank to have a specific proportion of the deposit in the form of liquid assets. What is the liquid asset? Liquid asset is all about whatever the funds, whatever the money which is easily transformed into the cash. That is called liquid asset. Excluding the cash reserve ratio, I will already discuss. But that you have to be keep themselves. Bank has to be keep themselves. You don't need to be keep with the RBI. Clear? Then this is all about the difference what we have already discussed. Then the bank rate policy. Bank rate is the minimum. The difference I now here I'll just try to discuss as two different concepts: bank rate and the repo rate. Repo rate is for the short term. Bank rate is for the long term. Clear? The bank rate is the minimum lending rate at the central bank at which rediscount first class bills of exchange and government securities held by the commercial bank. When the central bank finds that inflation has been increasing continuously, it raised the bank rate. So borrowing from central banks became costly and commercial banks borrow less money from the RBI. So RBI also control the inflation deflation with the bank rate. Suppose that bank rate used to be 6%, so banks used to be get the loans from the RBI at the 6%. If there is a more inflation in the market, what the RBI will be do? RBI will increase the higher the interest that might possibly 6, 7%, 8%. If the RBI kept the 8% bank rate. That means commercial banks will get the loans at a higher rate. The commercial bank will get the loans at the higher rate. They are lending out to those loans to the customer at the higher rate. The customers will take the less loan. The less loan, then the less purchasing power, the less demand. Then we can control the inflation rate. So bank rate is the minimum rate also. In the same time, bank rate is for the long term. Got it? And how we control the inflation and the uh, how we control the inflation or deflation, we just need to be understand, cut down the rate or increase the rate. In terms of the deflation, you have to be cut down the rate. In terms of inflation, we have to be increase the rate. Then the repo rate is for the repurchase rate. It is a fixed interest rate at which banks can borrow the overnight liquidity for the short-term loans from the Reserve Bank of the India against the collateral of the government and the other approved security under the LAF, Liquidity Adjustment Facility. So whenever repo rate is all about whenever the commercial banks are taking the loans from the central banks, that is called repo rate. So if repo rate is higher, commercial banks will take the lower loans, will take the less loans, at a higher rate. So they'll give the loans to the higher rate to the customers. Also, the customers will take the less loans. Reverse repo rate is all about whenever the commercial bank is having the surplus amount of the money, what they are doing, they are keeping with the RBI. RBI is giving the interest rate on those funds. That is called reverse repo rate. So when the commercial banks are keeping a surplus amount of the fund with the RBI is giving that certain amount of the interest. That is called reverse repo rate. Next is all about the marginal standing facilities, MSF. MSF is a window for scheduled bank to the borrow overnight from the RBI. It is for the overnight. You just need to understand. Whenever you are looking for any fund for any emergency, any commercial banks are in any emergency taking the loan from the RBI, then to MSF is for the overnight loan for 12 or for 20 hours. That is called marginal standing facilities. This is called qualitative tools, rationing of the credits, marginal requirement. If the policies will be very liberal, so people will take the more loans. Margin requirement, if suppose there is a collateral loans, there is a loans against the properties, LAP we do call it, loans against certain properties. So if earlier the property was the 100 rupees, the bank has to give the 80 rupees loans. So sometimes margin is more. If your bank has increased the margin, if you are keeping the 200 rupees property, then we are giving the 80%, 80 rupees loans. So margin can be increased or decreased depending on the market requirement, whether the inflation or the deflations. Publicities, where government of India, government of respective, or each and every banks are putting down the advertisement for the loans. In the last 2 decades, why these many consumer durables demand have been increased drastically in the last 2 decades? Just because of the EMI systems. What is significance of monetary policy? Control the inflation, the deflations, availability of the supply of the money credit, integrated interest rate structure, effective central bankings, long-term loans, creation of the financial institutions. So this is all about the monetary policies. Further, we are continuously in the fiscal policies. Objective of fiscal policy is same, but you just need to understand there are two tools of the fiscal policies: expenditure and the revenue. The government policy of taxation changing is a public expenditure and the program intended to achieve its objective. Objective is almost same, but in terms of RBI is not more concerned with infra development, but here in terms of fiscal policy, what we do: development of effective mobilizations, reduction in inequalities, price stabilities and control of the inflation, employment generation, reducing the deficit in the BOP, increasing the national income and development of the infra is again part of the fiscal policies. This is all about the tools of fiscal policies. We have a public expenditure and there are two basic tools: expenditure, the revenue. In terms of revenue, we have a tax revenue and we have non-tax revenue. And the expenditure, we have the revenue expenditure, we have a capital expenditure. So we'll try to discuss what is the revenue expenditure, what is the capital expenditure. First you just need to understand what is the capital expenditure. Capital expenditure, government expenditure or item which will start producing an economic benefit, help in the growth of the country, like a machinery, equipment, housing, healthcare, education, refers to the money spent to build it. So whenever government of India is planning to create the long-term asset and whatever the money they are spending, that is called capital expenditure. Build the new hospitals, new schools, railway line, airport, manufacturing equipment. This is called capital expenditure. So opening the new hospitals, new universities, new IITs, building the highways, airport, and seaport, that comes under the capital expenditures. In some same time, we have the revenue expenditure all about. But if you suppose you have been built any university or built any hospital, you require the day-to-day expenses also that come under the uh, revenue expenditure. You have to provide the salaries. You have to be required in terms of the hospitals. You have to provide the medical instruments, just like some ultrasound machines or some certain day-to-day operating expenses also requires from the house cleaning to the you have to provide the injections to the medical drugs or medicines. You have to provide each and everything. But in terms of the schools, you have to provide the accessory. So whatever the expenditure we are incurring to run the capital expenditure, that's come under the revenue expenditure. So all the salaries, all subsidies. Suppose that government of India have taken any loans from the interest monetary fund, world banks. So you have to payment. You have to make the payment of the interest also. Subsidies. Government of India providing subsidy in terms of the solars or EVs or gas subsidies. This is called revenue expenditure. Government of India have certain properties also. They also have to pay the taxes. So revenue expenditure is a recurring expenditure, day-to-day expenditure. That's come under the revenue expenditure. Capital expenditure created on the long-term assets. So we have discussed here also revenue expenditure, interest payment, major subsidies, defense, capital expenditure, repayment of the loans, extension of the fresh loans, loans to the public enterprises. All these things come under the capital expenditure. Then we comes under the revenue. In the revenue, we have tax revenue, we have a non-tax revenue. Clear? In a tax revenue, we have direct tax and we have indirect taxes. Simple. In a direct, we are not going to discuss it in detail. What is direct, what is indirect? Direct tax is the income tax, corporation tax, bill tax. Indirect taxes majorly is a GST, excise, and the custom. But apart from the tax revenue, we have the non-tax revenue also. Government have the non-tax revenue also. In non-tax revenue, we have the fines and penalties. Government of India is charging the RTO charges, whatever the fines and whatever penalties they are taking. At the same time, there are so many PSUs like ONGC, GAIL, and SAIL, and these many PSUs are running. Whatever the profit they are earning against parts comes under the non-tax receipt, interest grants, and gifts. The government of India have given certain amount of loans to respective state of their whatever the interest they are getting, that is comes under the revenue. That even we have disinvestment and the divestment. In every budget, you'll see government of India have planned for the disinvestment and divestment. Disinvestment is all about a certain part of the government property if you're selling in the public market, that is called disinvestment. Divestment is all about if you're selling the full stake of government to the public, that is called divestment. The recovery of the government loans, whatever the governments are given the loan that they are recovering those things, that is called capital receipt, the disinvestment. So this is all about the revenue. What are the sources of the income of the government? What we have already discussed, direct tax and indirect taxes. So we are not going to discuss this is how it is impacting on the market. Fiscal policy and what is the fiscal policy? Again, the same like a monetary policy, discretionary fiscal policy, non-discretionary fiscal policy, anti-recessionary fiscal policy, anti-inflationary. Anti-recessionary fiscal policy, what you will do if there is a more recession in the economy, then what you have to do? What are the basic reason? What are the basis reason behind of the recession? Low demand. Then what you have to do? You have to be pushed down you have to be inject the economy. How will you inject the economy? You have to be cut down the indirect direct taxes. Because once as government of India has cut down the and have increased the slabs up to the 12 lakh rupees, that means now people will have the more money. All those people who are earning up to the 12 lakh rupees don't need to be pay single penny of taxes to the government of India. That means will have the more money, more purchasing power, more demand. So in terms of anti-recessionary, what we have to do? In an anti-inflationary, what we have to do? So anti-necessary, what we are going to do, what example I have been given about that is all about it, cut down the indirect taxes or increase the slabs. Anti-inflationary, that means we have more inflation, then you have to be increase the taxes. Anti-recessionary fiscal policy, aggregate demand decrease, private investment falls, deflationary gap. What aggregate demand decrease? If there is no demand in the market, private investment will be fall. When the private investment will be fall, more employment, more deflationary gaps. In anti-recessionary fiscal policy, what we do, we already discussed, increase the government expenditure. Government has to increase the more expenditure in terms of subsidies, in terms of the infra, in terms of the road, in terms of the airports and the shippings, and reduction in the taxes also. Clear? This is all about the same what we are discussing about. And in terms of the anti-inflationary, if the more inflation the market, then aggregate demand increase. Why inflation? I already discussed the demand. I already discussed the inflation. If there is a less demand, there is a more demand as compared to the supply. Once the aggregate demand decrease, private investment rise. Once the private investment rise, there will be inflationary gap. Inflation, what you have to do? You have to reduce the government expenditure. You have to reduce the subsidies, and what you can do, you can increase the more indirect taxes. You can increase the more direct taxes also. So this is all about basis of fiscal policies. This is not important. You just need to understand what in terms of inflation, what you have to do, in terms of deflation, what you have to do, and what are the instrument of the fiscal policy. We have the expenditure and the revenue. In expenditure, we have the capital expenditure and we have a revenue expenditure, and in terms of the revenue, we have a tax revenue, we have a non-tax revenue. In a tax revenue, we have a direct taxes and we have non-direct taxes. Then very important topic, foreign exchange. What is foreign exchange? Foreign exchange is all about whatever the exchange rate is going on. Whenever we are exchanging $1 is equal to 80 rupees or 82 rupees, with reference to domestic country's currency's rate against the foreign country's currency, that is called forex. We do call foreign in a foreign exchange, we do call it a forex. Forex market is the market which participant can buy, sell, exchange, and speculate in a currency. Just like a stock market, we have the foreign exchange market also. Many people have been bought like a dollar few days ago. I've been told to many people again the dollar will be depreciate. It used the 87 rupees, now it became the 84 rupees. Still many people are buying. But at the same time, if suppose you are buying that $1 lakh at the rupees of 84, so 84 into 1 lakh it became 84 lakh. But one point of time dollar became 87 lakh rupees. That time you can sell those dollars. You are going to get the profit of 3 lakh rupees. So in a forex market, we do deal with all these many things: buy, sell, exchange. Who are the participation in the foreign exchange market? All those small businesses, central banks, retailers, MNCs, foreign exchange brokers, commercial banks. If you are dealing from India, because everybody knows if you are in India, if you want to be travel to across to Dubai, you can't use your Indian currencies in a Dubai market. Then again, you have to be exchange the currency. So who are the foreign exchange market? Start from the small businesses, central bank, that is called RBI, commercial bank, they require the foreign exchange. In each and every commercial bank, we have a foreign exchange counter. You can reach out to the SBI and ICICI Bank and Axis Bank where you can exchange your currencies. All the retailers, MNCs, and foreign exchange broker, they are the foreign exchange market participants. Then we are foreign exchange market. We already discussed. So forex market. Forex market is made up of two levels: interbank and the over-the-counter market. It's running the OTCs, means suppose that if I'm sitting in Bangalore, you are sitting in Dubai, so it runs over the counter also. The seller is sitting in Dubai, I am sitting in Bangalore, so I can buy your currency, whatever the currencies you are selling. Sometimes the interbank market also. So what is the foreign market exchange rate? We have the two rates: spot transaction and we have the forward transactions also. In spot transactions, what we do, buying and selling the securities against the payment. If suppose that you just want to buy this pen costs the $1 and $1 is 50 rupees. I'll be giving the pen to you and you have to pay the 50 rupees to me. If the dollar cost is 50 rupees and pen costs the $1. The spot transaction is an agreement between the two parties to buy one currency against the selling another currency at an agreed prices for settlement on the spot date. This is called like a normal market, that is called spot market. Then the foreign transaction, forward transaction, it's an agreement between you and the bank to purchase one currency against the selling another currency at a fixed prices for delivery on a agreement future date. You are putting down you are fixing the date by today for the future. That is called forward transaction. Suppose that today is the 10th of May, and this pen costs is $2, and the currency you are fixing your currency fixing the dollar is $1 equal to 50 rupees. So you are fixing the 2 days rate and the future date. In a spot, we are doing the same day. From the one end, you are giving the product, and the one end, you are giving the currency. In a forward, you are fixing the date by today, by the future date. The foreign exchange traded, one of the most fascinating things about the market, there is no breaks in the marketplace for forex trading. EB transactions is done electronic over the counters. Unlike the stock exchange, the forex market remain open around the globe for currencies traded across the every time zones 5 days every week, just like a foreign stock markets. This is the same what we are discussing. The basic concept, direct code. $1 equal to 50 rupees. Direct quote is when the one unit of foreign currency is expressed in terms of domestic currency. So $1 equal to 74 rupees, that is called direct quote. You just need to be understand. How much you just need to be pay your currency with reference to foreign currency, that is called direct quote. Indirect quotation, the when one unit of domestic currency is expressed in terms of foreign currency. 1 rupee is equal to how many dollars? That is called indirect quote. So in a direct quote, $1 is equal to 74 rupees. Now, indirect $1 is equal to how many rupees? The 1 divided by the 74. So this will be called 0.0135. Simple. Then the bid price and the ask price. Bid price is the banker's buyer price, the buyer point of the view, and ask price is the seller point of view. So most of the all the transactions always executed in the stock market, in the foreign exchange market, in the ask price. So ask price is the seller point of view, bid is the buyer point of view. Just need to understand. The bid price for a trader is always lower than the ask price. Yes, bid is always lower than the ask price. I am asking the 87 rupees per dollar. You are bidding down the 84 rupees. Then the cross rate, very important topic. Cross rate can be exchanged of any two currencies that are not or the official currency in which the quotes is published. Any currency exchange in which neither of the currencies, the US dollar, is considered the cross rate in the practices. Very simple. I'm just trying to teach you. When sometimes there is no exchange rate is not available between the two currencies. Got it? This exchange rate are not available between the two currencies. What we are doing, then we are finding out the third currencies where the exchange rate are available between the both the currencies. So firstly, we have to be exchange the currency with that currency, then accordingly we can make it out the payment. So $1 is equal to 19 rupees, 1 pound is 90 rupees, 1 yen is 72 rupees, 1. So what we could do, I've been given the example of, suppose that India, China, the same very simple example. India, China, and the US. So I just want to make it out the transactions between with the China. Okay, but I don't have any idea what is the exchange rate. But China is having the exchange rate with the currencies like US. Okay, and have the exchange rate with the US also. So what we do, suppose that $1 is equal to 50 rupees, but in the same time $1 is equal to 5 renminbi. That is renminbi or yuan of Chinese currency. That means what we can do, that means 1 renminbi is equal to 10 rupees. The cross rate, where we follow the cross rate is all about when the exchange rate are not available between the two currencies, then we are making out the one common currency as an intermediary. So firstly we are exchanging our currency with that currency, then accordingly we are making out the payment to the final country's currencies. Currency is calculated by multiply to exchange rate. Various exchange rate regime, we have discussed currency board system. Now we have what we have discussed. We have already given, this is very complex topic. You just need to refer my separate topic, separate lecture for the foreign exchange, which is again in the YouTube. We have two types of exchange rate regime, is foreign exchange, for fixed exchange and a flexible. In a fixed, we have currency board system, target zone arrangement, and currency pegging. The currency board system is the system whenever you are converting your country's currency with the foreign country's currencies. That is called, that works always done by the currency board system. And currency board, and how you are going to pick up that currencies in a very first time. But in the same time, you have to match the few things, just like a monetary policy, that there should be the same monetary policy, there should be the same economy, there should be the same fiscal policies. So whatever the country's currencies you are picking in a very first time to exchange your country's currency with the foreign currency, that currency is called anchored currency or reference currencies. The currency board system is managed by not sometimes, central bank of the countries. Then we have target zone arrangement. Target zone arrangement, when two or more than two countries started using the one common currency, the legal tender in the respective economy, that is called target zone arrangement. European monetary system, EMS, European monetary system is an example of target zone arrangement. Third is all about the currency pegging and currency basket. When two or more than two currencies mix and make the one new currency, that is called currency basket or currency pegging. SDR, spacer triangle is an example of currency basket or currency pegging. Yeah, this is very basic. We have already discussed. You just need to understand fixed and flexible. In a fixed currency board system, I'm again telling you, target zone arrangement, currency pegging, currency basket. In a flexible, we have two, free float and the managed float. In a free float, there is no intervention of the government. There is no intervention of the government of central bank. In a managed float, sometimes there is an intervention of the government. That is called, sometimes government of the respective state, they have been devalued the value. That is called devaluation also. That is called managed float. Direct code, indirect code we have already discussed, so we will not discuss more in detail. Cross currency rate we have already discussed. Currency appreciation, currency depreciation, I think everybody know. $1 is equal to 50 rupees, that is called nominal price. If $1 is equal to become 52 rupees against the Indian currency got depreciated. But $1 became 50 to the 47, that is the currency appreciation. Indian currency got appreciated against the dollar. Now what is the factors influences the exchange? Very important topic. What are the factors influences the exchange rate? Relative inflation rate. U.S. inflation increased significantly while British inflation remained unchanged. Assume that U.S. and British goods are substitute for each other. So sometimes if there is a more relative inflation rate, in a very simple Lama language, just need to be understand. If the things are costly in India, what we have to do? We have to go for the import of the product on the market. Why we are importing from the China? Because Chinese goods are always cheaper as compared to India. But at the end of the day, whenever you are importing the product from the China or some respective country, then you have to be exchanged because you can't make it out the payment to the China in the currency. Then you have to be exchange your currency with the Chinese currency. And then again, there will be more demand of Chinese currency and there will be less demand of the Indian currency. So if there will be more inflation in the rate in the market, then you have to go for the importing of the product from the overseas market. Whenever you are importing any product from the overseas market, there will be demand of those respective currencies where you are importing the product. So increase the US demand for the British pounds, decrease the supply of the British pound. They have given example by Britain, the US. Relative interest rate also, US interest rate increase while British rates remain constant. Suppose that in your respective economies, interest rates are higher on savings, or interest rates are lower in the savings, but in a US banks, interest rates are higher. So what people are doing, if suppose that I just want to make it out to invest the 100 rupees. Interest rate in the US is higher, but interest rate in India is lower. So I'll be giving the more preference to the US banking because I'll be getting the more interest rate. But whenever I just want to make it out any investment in a US banks. Firstly, I have to be convert our currencies in the dollars. Again, there will be more demand of the dollars as compared to the Indian rupees. So decrease the US demand for the British pound. US investor prefer the US asset due to the higher domestic rates, causing the inward shift in the demand due. In the same time, suppose that if Indian banks are giving the more interest, so what will we do? Yeah, you have already invested in 100 rupees in a US bank. So what you will do? You will withdraw the whole 100 rupees from the US bank. It will just need to be some deposit in Indian banks. So automatically, and the inwards of or inwards from the across the globe will be more in the Indian banking system. So relative interest rate also impacting all the exchange rate. Relative income levels, everybody know. If income levels is higher in your economy, so we are shifting towards the luxurious goods, we are shifting towards the imported goods. So again, there will be demand of the more luxurious goods. And asking again, there will be more import in the market. The more import, more foreign exchange required, then your currency is going to be depreciated. Government control, sometimes government imposing the barriers, foreign trade barriers, intervening the foreign exchange market also. Macroeconomic variables such as inflation, interest rate, income. These are the four factors which is influencing exchange rate. This is very basic. Next topic is all about the second last topic, I think, balance of payment. Balances payment is an annual statement of the systematic record of all the economic transactions between the resident of the reporting country and the resident of the foreign country during a given period of time. It is a double entry system of the record of all the economic transactions between the resident of the country. So whatever the transactions we are making from one country to the rest of the world, we don't just need to be understand, we don't need to be included domestic transactions in a balance of payment. We are just including all the international transactions in a BOP only. Clear? So whatever the transactions between these two economies are happening, so we are just including those transactions in a BOP account. So all the visible items, all the export and import, all the services, transport services, airlines, medical, tourism, all this comes, and capital transport, whatever the monies we are taking, whatever the monies we are giving, all things are coming under the balance of payment account. So it is a systematic record of all the economic transactions between one country to the rest of the world. Include all the transactions already told you relate to the period of time. We make the annual balance of payment accounts, but we are maintaining on quarterly basis. In every 3 months, we are making the BOP accounts. on quarterly basis, but we are publishing BOP account in front of across the globe on the annual basis. So balance of payment is a period of time, generally say annual statement. It has two side, debit side and the credit side. So all the credits, all the receipts are recorded in the credit side and payments on the debit side. That means if we are putting down the export, we are putting the export, that means we are getting the money, coming the receipts goes to the credit, and if we are importing any product, then we have to make the payment. The payments go to the debit side. So then what happens if the credit is more than debit, balance of payment is a surplus. If debit is more than the credit, balance of payment is a deficit. That means export is more than import, balance of payment surplus. Import is more than export, balance of payment deficit. Then the balance of trade is in a balance of trade we are more concerned about the product and services only. Now, what is the importance here is record all the transactions, create a demand for supply, just the economic and financial state of the country. BUP may confirm the trends, economic, international trade, and the exchange rate of the currency also. This may indicate the change or reversal in the trends. There are basic three or four, I do teach the four components, but most of the people do teach on three components of BOP: current account, capital account, official reserve, the errors and omissions. In the current account, we are more concerned about the risk, export and import. You just need to understand export and import, visual and invisible, interest rates, whatever the interest we are getting, whatever the interest we are giving, profits, dividend, unilateral receipts. Unilateral transfer means if suppose that your father and brother, your husband and wives are working in overseas market, you are sending gifts to those your family members. Unilateral transfers. So you just need to understand what are the things: export and import of products, export and import of services, interest, dividend, unilateral transfers coming under the current account. So in a if we are all this, we have the two side in a current account, debit and the credit. Credit is export, debit is the import. The credit is more than debit, current account surplus. If debit is more than credit, balance of payment. Current account is a deficit. Our current account is always in a deficit. Once it's I think twice or thrice in a last 70 years, only in a quarter, not in a annually. We used to be have the current account in surplus for only 2-3 quarters in the last 70 years. So in a capital account, in the capital accounts, we are concerned about the investment, whatever the FDIs, whatever the FIIs, whatever the loans we are taking, all the things comes under the capital accounts. Capital accounts records all the internal transactions that involve a resident of the country concerned, changing either his asset with his liabilities to resident of another country. In a simple just to understand. Investment, FDIs and FIIs, banking capitals, NRI deposits, clear, MNCs comes under the capital accounts. So we loans from international monetary organizations, World Bank, Asian Development Bank, Japan, US. But in a capital account, we have two sides: inflows and the outflows. If inflows is more than the outflows, if we are having more FDIs, means Google and Samsung and Apple is investing in India, that comes the inflows. If Reliance and Tata is investing in overseas market, that is called outflows. Inflows in more than the outflows, capital account in a surplus. If outflows is more than the inflows, capital account in a deficit. Got it? These are the classified into two categories: FDIs, portfolio investment, marketing, commercial borrowings, loan from external aids. Then the official reserve account. In official reserve account, we maintain the International Monetary Fund, SGR, reserve, monetary gold, all the foreign currency, all the reserves, and all the gold we are keeping in official reserve account. Errors and omission entries under this heads relate mainly to the leads and the lags and reporting. If there is any leads and lags in reporting, we are maintaining the errors and omission account. Now, what is the disequilibrium in the BOP account? BOP credit is more than debit, surplus. Credit is less than debit, BOP in a deficit. What are the causes in a BOP account? What are the causes of disequilibrium? Cyclical fluctuations in the economy, shortfall in the export. If export is less than the import, balance of payment is disequilibrium. Economic development of the economy, rapid increase in the population. Once there is a rapid increase in the population, your domestic industry, domestic companies are not able to meet out the supply. Then what you have to do? You have to go for the importing the product and services. That is called rapid increase in the population. Structural change in the economy due to the demonetizations of GST, any structural reforms you are making out, you have to go for the report. Natural calamities just due to the any more rainfall or due to any climatic changes. Again, there is an impact on the BOPs, international capital movement. So these are the causes of the disequilibrium in the BOP. Now, next question is all about how to measure the correct disequilibrium in the BOP. What are the monetary measures? Monetary policy, fiscal policy. Monetary policy is you have to be control the money supply. If there is things are costly in the economy, that's the only reason why we are preferring the lights or we are preferring the decoration items Chinese decoration item because they are selling at a cheaper rate. So monetary policy is controlling through the money supply, fiscal policy controlling through the taxation. The government of India started imposing the higher taxes on the imported goods, so they will not be importers will not able to import the product on the overseas market. So these are the measures: monetary policy, fiscal policies, exchange rate depreciation. If the currencies have been devalued or depreciated, so we will not be importing any product and services. So we will looking for the more export. The devaluations, the deflation, exchange control, non-monetary measures. We have to promote the export. We now government of India have started schemes like a ODOP, Bund District One Product. We have special economic zones. We used to be have EPZ, export promotion zones. So we have to be promote the export, control the export promotions. Country may adopt the measures to stimulate the export, like we have to be eliminate or reduce export duties. We have to provide cash assistance, subsidies, or good mean for the export can be exempted from all types of taxes. So all those people who are in export houses, the government can be give rebates on exemptions on the taxes. Then import substitute. Whatever the product and services we are importing, if we have a substitute product for those things, then we don't need to go for the import. If we have less import, then automatically the BOP will be in an equilibrium condition. Import control, we can pick it out quotas and tariffs. Clear? This is all about the POP account. Last topic is all about again one of the most important topics is aggregate demand and aggregate supply. In the last, I think it has been almost more than the 100 minutes of lecture. So you must have the basic understanding about how the aggregate demand is more than aggregate supply, how it is impacting the economy. The aggregate supply is more than aggregate demand. Aggregate demand is more than aggregate supply. Inflation, deflation. The aggregate supply is more than the aggregate demand is more than aggregate supply. Inflation. Aggregate supply is more than aggregate demand. Then deflation. Now, what is aggregate demand? Aggregate demand means the total amount of the demand for all finished goods or services produced in a given economy. Aggregate demand includes all the purchases made by the individuals, businesses, government, foreigners, and exclude the portion of the demand that is met by the importers from other countries. In general, the aggregate demand, GDP, and GDP increase or decrease together. Aggregate demand, because aggregate demand decrease, automatically there is a GDP will be decreased. Aggregate demand decrease, that means there will be a symbol of recession, symbol of slowdown. So aggregate demand is a macroeconomic term that refers to total demand for goods and services in a given period at any given price levels. Since two metrics are calculated in the same way, aggregate demand over time equals GDP. Aggregate demand and GDP increase or decrease together the result of same calculation method. Just the way we calculate the GDP, the way we calculate the same manner we calculate the aggregate demand. Aggregate demand is sometimes called the domestic final demand, that is called DFD. Like what are the components of aggregate demand? The first is the government spending. Government spending is the total amount spent by the government infra. So whatever the governments are spending on in terms of infra, investment, defense, military, public sectors, it does not include spending on the transfer payments such as pension plan, subsidies, and aids transfer to the government. But in terms of consumer spending, consumer spending is the largest component of aggregate demand. If consumers will not be spent, they became miser. They are not ready to spend 100 rupees, 200 rupees, 300 rupees. There are many people who are earning the 5 lakh rupees in a month, but they are spending only 50%. Only spending remaining 50% they are not spending. So consumer spending is one of the largest component of the aggregate demand. At the end of the day, aggregate demand will be increased when the consumer spending will decrease. But how to increase the consumer spending? There will be a more money supply. How to increase the more money supply? Reduce the direct taxes, in the same time reduce the interest rate. Once you reduce the interest rate, central banks are giving the loans to the cheaper rate to the commercial bank. Commercial banks are giving the loan to the cheaper rate to the customers. So once customers have the more money, government of India have reduced the direct taxes, so automatically consumer spending will be increased. So it refers to total amount spent by the individuals and household. Individual and household, whatever the amount of the money we are spending in the goods and services, it is influenced by the number of factors, include disposable income. What is disposable income? Again, the direct taxes. Your package is 20 lakh rupees, 30% is the flat taxes. 20% out of the 20 lakh, 30% becomes 6 lakh rupees, 14 lakh rupees is disposable income. What is the per capita income of the economy? Debt, consumer expectation of the future economic conditions. It is important to note that consumer spending excludes spending on the resident structure, which is included in the investment spending component. The component is government spending, whatever the government is spending, again part of the aggregate demand. Consumer spending. Investment spending in terms of the corporate, whatever the money they're spending into the machinery, equipment, inventory, investment in all non-residential structure or resident. Then the next export minus import. Export a product manufactured by domestic producers and sold abroad. Whereas import a product, I think everybody knows what the export is import. Whatever the net export we have, whether it's a minus or plus, this is to be included in aggregate demand. Now we have two sector model. What is a two sector model? In a two sector model, we are more concerned with choosing household and firms. So household private labor receive income, they spend their incomes on goods and services produced by the firms. The two sector model, closed economy without government. It is not feasible, it is not possible. No government, no foreign trade. It is not possible. And across the globe, it can't, except the North Korea, in no economy or no foreign trade. Two sector model is household and the firms. Three sector model, we have household, firms and government. There is an intervention of the government also. Clear? C plus I plus G. Sector model, C plus I plus G plus X minus M. A component, household, firms, government in the foreign sector. In the foreign sector, we are more concerned with the net export. Got it? C plus I plus G plus X minus M. Now, calculate the aggregate demand. The aggregate demand equations calculate the consumer spending, whatever the consumers are spending, whatever the private investment are coming, whatever the government are spending in terms of subsidies or infra, and net of the export and import. So C plus I plus G plus NX net export, it comes under the calculating the aggregate demand. I hope everybody is clear with the how to calculate the aggregate demand. So what is the uh, interpretation of this particular aggregate demand curve indicate the total amount of the goods and services demanded by the economy at various price levels. Price level of the all final goods and services is represented by the vertical axis, and the horizontal axis represents the real quantity of the goods and services. So the price of goods and services rise or falls, demand rises or falls. Everybody knows the prices of the goods will be increased, so demand will be falls. Less prices, more demand. Clear? You can make it out the aggregate demand curve. Furthermore, the curve can shift due to the changes in the money supply or tax rate increase or decrease. To fully comprehend why prices increase led to the lower spending, we must first comprehend how prices change affect the various component of the strategic or aggregate demand. So whenever there will be more higher prices, there will be less demand of the goods and services. So what is the factors influencing the aggregate demand? The first is all about the P goods. P goods used to be the economist. Aggregate to the P goods wealth effect. Consumers are wealthier at the lower prices. Whenever we have the prices at the lower, so we will have the more purchasing power. Assuming the wages are constant. At a lower prices level, disposable income is always higher, allowing the consumers to spend more on goods and services, increasing the demand for the output. The product for the price and goods and services is lower, and so whatever the incomes we have, that will be more than enough to spend those things. So automatically we will spend more. Automatically there will be more production, more demand, more production, more employment generation. As the price level rises, purchasing power of the saving held in a bank account other decrease, being eaten away to some extent by the inflation. Consumption spending will fall as the price level rises. Clear? As the price level rises, consumer spending will be fall. This is P-Goods effect. Next is the interest rate effect. Interest rate effect explained why. As the output rise, overall output rise, the some purchase require more money or credit. Interest rate will rise the result of the increased demand for the money and credit. Higher interest rate in turn will reduce the borrowing of the business. Whenever, just like a monetary policy I have already discussed, we have the more repo rate, higher repo rate, banks will be take the less loan, banks will take the less loan because banks again going to be charge higher prices. Consumers will take the less loans. So higher the interest rate in terms will reduce the borrowing, reduce the borrowings by business for investment purpose, as well as the borrowings by household for the homes, the automobiles also, thus lowering the both consumption, the investment spending. So why people are now, as of now, even 11th and 12th, the undergraduate students are carrying this two-wheeler and the four-wheeler, having the lakhs rupees, 80,000 rupees mobile phone, easily everything are available with no cost EMIs or very minimum interest rate. Then the exchange rate effect, when the value of the currencies fall in relation to other currencies, domestic goods become more affordable. If our currencies got depreciated in India, so automatically our goods will be more affordable for the foreign people. Then foreigners while import become more. Then in the same time, whenever we will import the product from the market, it will be more expensive. As a result, the lower price levels when domestic goods are cheaper than the imported goods. So what will be happen? Imported goods will be costlier because currency got depreciated. So what will be happen? Demand for the export rise. Export demand will be rise in the same time, resulting in increase in the aggregate demand for the country. Now, change in the aggregate demand, how the aggregate demand is a shift or change in the aggregate demand can represent change in the aggregate demand. It's an illustration of two ways. A shift to the rise of the aggregate demand of 81 to the 82. Indicated quantity demand of the real GDP has increased. The real GDP has increased at the same price level. Price is same, but GDP, real GDP has increased. Your aggregate demand curve will be shifted to the right, but the opposite is the left. But in a shift to the left of the aggregate demand curve, 81 to the 83 indicate quantity demand of real GDP has decreased. And overall, the real GDP has decreased. What is the real GDP? I have already discussed on in a national income topic. With the same price level, if your real GDP has decreased, that means your production capacity has been decreased. Earlier, it used to be produced the 10 marker, now you are producing with the 8 marker. So automatically your aggregate demand will be shifted to the left. Clear? Simple. No need to be going in detail. So what is the significance of aggregate demand? It is a method of examining the total demand for goods and services in an economy. As a macroeconomics tool, you should help determine and predict overall economic trend, assessing the economic health, how the country is progressing. This is all about the very basics of aggregate demand. What are the drawbacks? Drawbacks is all about is present only total output the given price level does not always reflect the society quality of the life or standard of living. Sometimes we are just because of the bandwagon effect, just because of the show off, we are spending more money. So in aggregate demand, we are more in terms of the more quantifiable. It does not affect, does not reflect the quality of the life and standard of living. When it comes to the aggregate supply now we have supplier perspective. So whatever the total output of the economy comes under total supply of the goods and services produced within the economy in a given period, that is called aggregate supply. So aggregate supply is represented by the aggregate supply curve that shows how the quantity of items, the price related. Now the same thing, how the prices of the product and services increase or decrease and how it is impacting on the aggregate supply. So aggregate supply, the domestic final supply, that is called DFS, means total supply of the goods and services produced within a national economy. So short-run aggregate supply is how this is affecting one to two. So aggregate supply describes the relationship between price level and the quantity of the output that firm is willing to provide. Aggregate supply and the price level have a positive relationship. Aggregate supply is usually calculated over a year since the changes in supply tend to the like change in the demand. The horizontal is all about the diagram represents real GDP and the price level is the aggregate and a vertical axis. Whenever there will be more prices supported, so always a shopkeeper will try to be sell more product because they'll get the more money. The average price of the all goods and services produced in an economy is referred to the price level. It is an index similar to the GDP deflator. So the average price of the all goods and services produced in an economy is referred to the price level. Clear? And throughout the year. The vertical axis shows the price level for the final goods and output purchased in the economy, not the price level for the intermediate goods that are input. The simple you just need to be understand if you are keeping the more prices, if you are keeping the more prices, P1 to the P2, so automatically there will be a chances of the more supply in the market. In long run there will not be any. In a long run there will not be any impact. It will be same. You can't as of now if you are increasing the prices for today, clear. You can't make it out any plan for the long term. Whether it will be increase the more supply in after 5 years, after 10 years. You never know what can be happening the very next day. But in the short term, what will be here? There will be a shift in a short term supply curve. So this is again short term aggregate supply. Short term aggregate supply is considered a valid description of the economy supply schedule only a short term. Supply curve is only run in a short term only. Short term defined as a period that begins immediately after price increase and ends when input price have increased in the proportion that the prices increase. Price paid for providers of input goods and services refer to the input prices. Example of input prices are the wages paid to the employees, interest paid to the capital providers, rent paid to the landowners and provided. So at the end of the day, you just need to be understand whenever you are keeping the more price levels in a short run, so automatically you are going to increase the more supply. So short run aggregate supply, and at the end of the day, you will have the more real GDP. The long run aggregate supply, you no need to be bothered about. It will be always the natural level of the real GDP. Okay, it will be same. So long run is short term. In the long run, there is no impact. The change in the aggregate supply curve, how it is impacting from depending on the price level. Shift to the right of the SRAS curve from 1 to the 2, 2 to the 3. Yeah, a long run may indicate the quantity supplied to real GDP has increased the same price. The same price level, if the GDP has increased from GDP automatically increase, automatic supply will be increased. The real GDP. Earlier it used to produce the 10 products. Now it started producing the 12 product, 14 product, 15 product, the same price level. Price level would be remain same. If the price level would remain same, at the end of the day, you have to increase the more production. Then only more production, that is all supply. You have to increase the more supply. If there is a more supply, then only your supply curve will be shorter run supply curve and the long run supply curve will be shift. This is the input price and economic growth. I think basic. The significance of aggregate supply. Importance of aggregate supply was discovered in 1970. Reduction in the oil supply, orchestrated by the Saudi Arabia in late 1973, resulted in a rising unemployment and inflation in the US. Higher unemployment, according to Phillips, should have resulted in a lower than inflation rate. Whenever you have the high unemployment, you have to keep the lower inflation rate. This is all about the you just need to make it out the reading of the drawback of the aggregate supply, what how it's understand market. This is all about theories. I don't think so. It's important the theories of sticky base theory, just like a base spiral theory. Nominal wages are sticky in the short run. They adjust sluggishly due to the labor contractor social norms. Firms and workers set the nominal wage in the advanced phase, the P, the price level they expect to the prevail. Whenever you are increasing the price the same, the wages, all the laborers will be asked for the more money in the market. Then you have to be keep the, then you if you want to be increase the more money, more wages to the laborers, automatically at the end of the day you just need to be absorb those costs. You have to be increase the prices of the product and services. Then you have to be increase the then again automatically inflation will be derived in the market. So if P is greater than the P, E is expected, revenue is higher, but labor cost is not. Production is more profitable, so firms increase the output and the employment. As of now, you are saying your expected price is suppose today the 10th of May, your price of the market is 10 rupees. In the next year, price is going to be 8. So what you will do? As of now, your revenue will be higher, but labor cost is not. Production is more profitable because as of now, your other factors remain constant. Will try to be enjoy more profit, will increase more output, and will increase more output. Automatically, employment will be increased. And the higher the P, then higher the Y. Y is all about the income. This is all about the basic misperceptions from sometimes what we do is all about the firms may confuse, change the price, P, change the relative price of the product they sell. Sometimes we have the misperceptions after few days, after few the price of the product and services is going to be increased. We started selling more. So this is what is the common in this. But these are not the important. Just need to be understand basics all about aggregate demand and aggregate supply. That is more what is the significance and how the aggregate demand and aggregate supply work and how to calculate the aggregate demand and aggregate supply. So this is all about the today's lecture. If anybody is having a doubt, please to ask me. Otherwise, we have to conclude the today's session. In the meanwhile, if you do feel class, so whatever the queries you have, you can send me the queries. So thank you so much for joining and good luck for your examination. Thank you. Best wishes. Bye.